Ugh, this is what dreams are made of.
I'm a broken record on this podcast, I'm sure, but it feels like we're living the dream, building something that we want and doing it the way that we want to, that feels right. Welcome, Roman.
Greetings.
Hello.
Hi. Hello.
Good afternoon. Welcome to another episode. I just today finished submitting or sending out invites to our Full Send Fall Bash that we've got
Holy cow.
going on next week.
I am so excited. Our first annual party, and it looks like we're gonna have about 100 people there, and we're just gonna jam to some bluegrass. We're gonna support a good cause. This is what dreams are made of.
I'm a broken record on this podcast, I'm sure, but it feels like we're living the dream, building something that we want and doing it the way that we want to, that feels right. And part of that is building community, getting people together and having a good time, building connections.
And good time will be had. And a lot of our friends will be there, a lot of our network connections, and folks in the venture capital space, which is what we'll tee off on a little bit today. Do you want to give us some intro of what we're going over?
Yeah. Today, top of mind for me this week, which is what triggered this conversation topic, is SaaS and CPG and general company metrics and reporting, and how those reporting requirements change across a company's life cycle from pre-revenue, Series seed financing through Series A financing, maybe no financing, bootstrapped. There tends to be a lot of different reporting that changes through that cycle. And I think it's fun to talk about what might cause those changes, how to make it better, and where different requirements might differ across different stages and companies.
Yeah, things change a lot, and we've focused on this market segment of really pre-seed through Series B. We see a lot of companies outside of that, but are strategically positioning themselves for growth. In that category, there's a lot of change that occurs, and for us as accountants and finance professionals, we need to be ready for that. We need to be prepared to educate our clients, to support them, to equip them with the right data to make decisions. So how about we start at the seed stage or early stage?
Yeah, I think that's a great start. Do you want to talk a little bit about industry specific or just seed stage? What you typically see?
We could go either direction on this one. Why don't we start with SaaS? Because we see a lot of SaaS companies. So SaaS is the seed stage. So at this point, they have likely raised a friends and family round, have an initial amount of traction in market, maybe have some early revenue being generated by their customers, and are pouring money into sales and marketing and product development. So for SaaS companies at the seed stage, we often see a variety of contracts, contract lengths, contract terms, contract levers. There's very little consistency in that realm. And for us, from a revenue perspective, that is probably the single biggest item that causes complications for us when I'm thinking about deferred revenue.
Mm-hmm. Yeah, and the systems that are in place to track that, at a young early stage company, you might be charging customer cards on multiple different platforms and centralizing all this information into one repository that can tell you what's our MRR. That might be more difficult than it needs to be or that it should be in order to scale.
It's interesting to me because we get that question a lot. What's my MRR at now? What's my ARR at now? And when companies come to us, they often are on a cash basis. They're recording revenue when the cash hits the bank. And so it results in this really lumpy revenue month over month. And it's very difficult to tie that into ultimately what is your monthly recurring revenue on an accrual basis. If that cash is then amortized over the course of a contract, then we can have that MRR. But it's a question we get a lot.
Yeah, and I think what's most important with these seed stage companies is recognizing truly where they are within that stage. What's important to them? How quickly are they growing? Because we want to recommend certain improvements to processes or systems when company's ready for that. If a company's not ready to afford or find value in a cash to accrual basis of accounting, we don't want to recommend it. But if a company is growing pretty quickly, they're seeing growth happening quite a bit, we want to start thinking more forward looking on how can we start to build the infrastructure today to prepare you for that Series A financing that might be happening down the road. Those are
Yeah,
different conversations and approaches.
they are, and there's no golden rule for that. We just picked up a client. They're doing about 2 million in ARR and are operating on a cash basis. And they've been growing steadily enough to where it hasn't become a problem for them, but are very intentional now about trying to get the types of metrics, the types of reporting that they need to make better decisions as a management team. Now, that inflection point can come much sooner than a 2 million ARR mark, and oftentimes does, because that type of reporting and metric tracking is so necessary and critical to success at that early stage.
Yeah, I want to talk a little bit more about those metric tracking and reporting because in my exposure now to multiple different accounting firms and services that they provide, one of the gaps I see is that accountants don't typically, there's a ton of firms that do this very well, but typically don't speak SaaS at all. And by nature, that's because the metrics that SaaS companies are measuring, MRR, ARR, churn, CAC, LTV, all these acronyms, they're not GAAP basis metrics. And oftentimes to calculate these things, it must be done outside of the general ledger because recognizing revenue to GAAP does not prepare the data to look at MRR, or MRR does, but let's just say churn or even the CAC value over time. So usually there's another step that's required to pull in data from different platforms, maybe Google Analytics or however you're measuring the marketing spend for CAC, for example, pulling in data from another source, which that skill set, it just isn't necessarily available in every accounting provider.
Yeah. And we have that conversation often, right? And therein lies the primary difference between maybe somebody that's more bookkeeping, accounting focused, and somebody that has more of a finance lens, that's
Mm-hmm.
oriented towards business growth and management reporting. Because when you start to get into these calculations of the metrics that you're talking about, it requires industry knowledge. It requires an understanding of how to maybe complete some allocations that need to be made on the P&L, and then having to take that data and rework it into a metric that makes sense. It's just a different skill set than bookkeepers. And people come to us and they're like, hey, my $200 a month bookkeeper isn't giving me this. I'm like,
Mm-hmm.
they're not supposed to. That's not what they do.
Well, what I see too often is sure, your bookkeeper will do the accounting and the books are fine. But then you might have a marketing team or someone else internally who's pulling these metrics manually from different data sources. And they're computing those different metrics that the management team needs to send out to whoever might need that data. Um, as companies grow and scale, the complexity with that is that the data likely doesn't always tie back to the financial data. So the way that the marketing team might be computing CAC might be different from the way a finance person would, because a finance person knows everything that's coming into the marketing spend, and the marketing person might only know the vendors that they're working with. So I think there's oftentimes timing differences in terms of when the revenue is recognized. So I think it's very important at an early stage, probably more Series A stage, for companies to sync those two up, is to kind
Yeah.
of have the data and reporting team talking to one another to make sure that inputs are all consistent across every reporting database or system.
Yeah, and I'd say it's often more of an art than a science. because when you allude to things like timing differences, maybe in marketing or maybe an accountant would say, here's a one-to-one relationship between my marketing spend this month and the MRR that we recognized. Well, if you take a step back and look at your sales conversion metrics, if you look at your typical sales cycles, all right, well, the spend that you incur today actually doesn't relate to any MRR that you grew this month. It's actually 2-3 months down the line. So how do we tie that data together and create the right reporting to reflect how the business is actually operating?
For any listeners out there, if anyone's found a way to automate this really well, we should talk, because I think there's a need for it in the market of, I think it's easier to forecast it, but doing a budget to actual against these type of metrics, I haven't seen anything that exists. I don't know if you have.
Not specifically, no. These are the types of pain points that exist for everybody. It's not just early stage companies; it's large companies, everybody in between. But ultimately, because you're looking at non-financial or non-GAAP metrics, that's where the art comes in of being able to understand the business well enough, understand the cadences, the timing, and take data from different departments and coalesce them into a single report that management can rely on. And it takes time. It takes time to dial that in.
Yeah, one thing that I've seen trending in large companies and just in the industry is that finance, or the office of the CFO, is starting to adopt the data function, and having the data and reporting function across small or massive companies ensures that everything is tied and kind of beating to the same drum across the organization. That's something that Brad at Sunday did really well. He's a VP of finance there, and he adopted the data in infrastructure team, and they were able to build out everything within an internal data warehouse, which allowed all of the inputs to be consistent. There were often headaches from the finance team of not having consistent reporting that the marketing team might have been publishing. So centralizing that is a big step. That's obviously later as the company has an internal function, but you're still working toward that at the early stage. And once you get to those round of financing, Series A, Series B, when investors are starting to be a bit more critical and need the details behind the results.
Yeah. Is it critical to have a data warehouse at your seed stage in order to funnel that into your financial reporting? No. Is having the right foundation and infrastructure for your finance department necessary in order to enable you to have that in the future? Yes. And so those are things that we've been talking about internally of like, how do we take this big company mindset, this data warehouse approach to make sure we have data consistency across every vertical of the business into a small company? And it is a very unique and interesting problem that we're looking at and trying to wrangle and figure out how to solve. But ultimately, that's the direction that our industry is going and professional accountants are going.
And that piece of it marries very closely to the accountant and what the accountant is providing. And a lot of the change is going to be on our shoulders of communicating to our clients and to company owners the value of a strong accountant that partners well with someone who can also provide the finance and reporting. You can never get that finance and reporting data unless you have this strong foundation of a good accounting team.
Right.
So it's about education. A lot of it is about education. You can't just easily pull up these reports.
No, it takes a lot of financial engineering in the background. And ultimately, we want to provide a consistent enough bookkeeping service in order to feed the finance department so that our clients don't have to come to us and say, hey, did that bill get paid? Did this invoice get recorded? They have the confidence knowing that that is completed to where now they can ask us, hey, can you tell me more about my cohort retention? Or provide, my updated metrics on LTV to CAC based on real-time actuals. Like those are the types of problems that we want to be in a position to solve versus the tactical, did my invoice get paid?
Yeah, that should never be the primary question. To me, that indicates we're not doing our job well. if those are the questions that are getting asked.
Right.
But I think that's why you and I and other industry leaders need to be out in the forefront having these conversations, because everything's going to continue to change with data and AI. And it's really important for us to have a pulse on how could we be doing it better? How are other providers servicing their clients? What do clients need? And making sure we're not living in this vacuum of we'll provide this service. This is how we always going to provide this service. There's not much room for innovation because of XYZ. That's not the business I'm interested in being in. It may be harder in the long run because it requires additional change, but I think it overall providing a better value is more important than the additional time it might be required.
1000%. And I'm not going to go on a tirade about why community is so important, but I will say a lot of what we're doing and the things we're getting involved in is not just so that we can provide a really good service to our clients. Like, that is a primary outcome of us spending time trying to figure out these problems for the industries that we serve. But it's also to educate and empower and inspire other accountants. Like, we want to support those that are around us to lean into these things so that they can provide a better service to their clients too. Like, this conversation is constant with us. And if we're continuing to inspire accountants to change both internally and externally, we're going to leave a really good mark on the space.
Well, back to culture, because that's where we always go in these conversations. But that's what I want with our team members.
Yeah.
I want our team members out on LinkedIn, talking to people, having a pulse on the industry. And that comes at a risk, right? That they'll see new roles that are posted. They'll understand how different companies are doing things in different ways. But I want to build it so everyone in the firm feels empowered to know what's going on and be at the forefront of opportunity.
Yeah. That's why you've gotten on LinkedIn doing a podcast. I love it.
It's like I'm turning a new leaf. I don't know who I am anymore on podcasts and posting on LinkedIn.
As long as you're having fun, I'm having fun.
I am. Okay. We talked mostly about metrics from Series C through Series A. Do you want to touch any more on like requirements of VC-backed companies or get into any industry specifics outside of SaaS?
Yeah, so one thing I think is important to note, particularly as you graduate from seed to Series A, and this comes from many, many conversations that we have with founders every single day. At the seed stage, there tends to be maybe an overemphasis on some of the things that our clients and prospects want. They say, hey, I really need to have X, Y, and Z. Maybe it's GAAP financials, or maybe it's some type of reporting that is required. And what we try to do is maybe reframe the conversation at that stage, at the seed stage, to say, we want to yield quality enough reporting for you to make the best decisions possible for you at this stage, because your investors at this stage are less focused on your actual financial results and more focused on your growth trajectory. So at that stage, it's not imperative that the financial reporting meets X, Y, and Z criteria for the investors. Whereas as you move to Series A, that bar gets a little bit higher for the type of reporting you need to deliver. Maybe there are covenants that you're required to meet. And so the emphasis is largely financial reporting at Series A versus where we hear a lot of that chatter around seed stage as well.
Yeah, and at Series A, you're typically getting a board in place, and the board is driving a lot of those requirements for growth or whatever it is that they deem appropriate. So it's different. There's different requirements at those stages, and it's always goes back to having that foundation to be able to improve it and not having a major project to overhaul the whole infrastructure to be able to put those reporting metrics in place.
Right. The last thing that you want is that the first dollar of your Series A revenue going towards fixing your accounting and finance department. Like, you want to take that money and pour it into sales and marketing, pour it into product iteration in order to continue scaling going forward, and not have to rewire your entire accounting function.
It's similar to, I've obviously have a lot of experience in CPG, and it changes over time too. I mean, we're not typically talking about similar things like churn, MRR, because you don't usually have recurring customers. When I was at Sunday, it was a little different because it was a subscription physical product. So we did have like this combo of CPG and SaaS built in, which had its own complications and complexities. But CPG, I tend to think it's a bit more simpler because the reporting metrics are more consistent with GAAP financials. And, there's likely a reason for that because the accounting industry and the standardization of GAAP is a little bit behind in terms of not yet adopting SaaS-based reporting.
Sure.
But I tend to think, gross margin, contribution margin, those things are a little bit more in line with the way you're reporting, so long as you have a strong accountant who's using the integrations with Shopify's or other platforms to automate a lot of this stuff. Because what you don't want is have to wait 15 days to get your revenue recorded when you could have it real time and your accountant's then just buttoning up a few things and you can still make the decisions you need to real time with the accounting happening a little bit slower on the back end.
Yeah, and I think you feel really comfortable in that space from a metric standpoint because you know the accounting really, really well. The nuances of the industry, the inventory movements, how manufacturing processes occur. And that's where I would say, from an industry perspective, CPG, from an accounting perspective, purely accounting, is going to be far more complex than SaaS because of inventory, because of, if you're manufacturing your own product, it is challenging. The distribution networks, there are a lot of complexities. Yet, from a metric tracking standpoint, there may be some simpler elements of that.
Yeah, and we talked about how in SaaS, if you don't build that infrastructure from day one, you have to rebuild it later. I'd say it's even more important on the CPG side because the messes and tangled webs that can happen in CPG and inventory specifically from an accounting perspective, purely accounting, it can get very messy very quickly. And if you don't have that strong basis and baseline for getting everything reconciled, making sure things aren't going to the wrong place, typically what that ends with is a massive inventory write-off and your margins just go down the toilet because your accounting hadn't been done correctly historically. I've got to figure out a way to better articulate how and why those messes happen because I understand the accounting that causes it, but I struggle with communicating that in layman's terms.
Yeah.
I'm going to work on that one in the back end and figure that out. But, I see that with most of our CPG clients that we onboard, that their prior provider just didn't have the data or the reporting that was necessary. And now we're having to redo it, get a good baseline, and it can be costly.
It can be costly. And that is the cost of working with an outsourced provider that doesn't know your industry. And so I want to ask you then, if maybe articulating some of that is hard because there are so many details involved, how would you recommend a CPG operator who is, in their kitchen creating something, a new energy bar, right? They're in their kitchen, they've got some sales online. What steps should they take in order to make sure that they don't have that massive inventory write-off 2 years down the road?
Well, I think it's most important to identify the cost benefit because a good CPG accountant needs to spend more time. It's kind of a knife in the heart because the CPG has lower margins and it requires more time and effort to get the accounting right. So lower margins, but you need to pay a little bit more to your good accounting provider. I don't love that, but it's a cost benefit of timing, right? If you're selling 10 bars a week, don't even think about it. But once you hit that critical mass where you have a distribution center or a 3PL or you're hitting consistent sales that are bringing in pretty high level volumes, I would say finding a provider that, going through the checklist of your business. Have you worked with 3PLs before? Have you worked with distribution centers before? How would you go about reconciling our inventory? And it's challenging because you don't know if they're telling you the answer that makes sense or not. But at least you're starting to have those conversations around, does this person really, have they done it before? What resources are available to them if it's something new? And also, like, what type of metrics can you provide for me on an ongoing basis? Are you going to be able to tell me my gross margin day in and day out? Are you going to use any automation? That's the biggest thing I would recommend identifying, because Shopify revenue and data recognition through journal entries is a thing of the past, and we don't need to do that manually anymore. So if we can automate that, that's the best solution available. But just getting someone with industry knowledge and having done it before, I think, is the most important item to making sure it's successful.
And so when that woman who's creating the energy bars in development stage, starting to get some of that early revenue, would you say, hey, your life will be so much simpler if you go utilize a co-man, and for you to be able to wrangle that data and understand your accounting better before hiring somebody, or go buy a machine to where you can increase output and volume, rent some space, and do it yourself?
That all depends. I mean, if you're going to buy a machine, it's typically a large capital investment. And do you have that available to you? Do you have someone who can help you finance that? Usually that's not the case. And therefore, companies tend to go the co-man route. I personally recommend the co-man route because having a strong co-man and co-packer usually comes with industry suggestions, or, hey, this is how we do it. This is our accountant. This is how we work through these things in the back end. And you eliminate a lot of the trial and error that comes out of the R&D for building your own internal process. Less risk,
Yeah.
I'd say.
Yeah. I'm just curious to get kind of tactical on that, because there are those types of decisions that can occur early in any stage company, or any early stage company industry, that can have a ripple effect on down the road. So if you make that big capital investment, you're self-manufacturing, well, now inventory tracking is going to be pretty challenging, whereas the co-man's going to absorb some of that responsibility.
Yeah, and I think it depends too on your product. Are you making something that is pretty common, like a bar? Your co-man's probably going to be able to pick that up and provide a quality product pretty easily. We have one client that builds campers, and it's a highly capital intensive process, and they're doing a lot of the capital improvements themselves because, one, they couldn't trust someone else to do that for them, and two, it's just a better solution for them long term to be able to hold that and scale it internally. So it all depends.
Which is a good answer.
The best answer.
Yeah, it's a great answer. And those are the types of conversations where, if you align yourself with an accounting or finance provider that knows your industry, those are the kind of conversations you can have to say, hey, I'm thinking about buying a new machine, a new piece of equipment to help out our manufacturing process. Let's look at this investment and see what our ROI is going to be, what the payment plan is going to look like, and how quickly we can spin up our volume to then realize that increased revenue capacity going forward.
Yeah, exactly. That's exactly what the camper company did. They wanted to expand their square footage of their internal warehouse. So what does that mean for capacity? How quickly can we recognize those sales over time? So they're all intertwined, and just having a resource to talk through those things, who understands.
Thanks for tuning in to this week's episode of Building in the Wild. If you found value in our conversation, we'd appreciate a review on Spotify, really Apple, wherever you get your podcasts.
And those are also,
to stay up to date, make sure to hit that subscribe button. For more insights and additional information, our YouTube is at Full Send Finance, and our website is fullsendfinance.com. Remember, the business landscape may be wild, but you don't have to navigate it alone. Build together, go further.
Because they have familiarity with it, and you can really get a good sense as to how to manage your business more effectively.
That's all we want to do at the end of the day.
Yeah, and we can, again, go back to core values. Is the service we're providing excellent? Are we being a good neighbor? Are we shipping daily and meeting the needs of our clients, and doing that in a way that we know their industry, we know their business, and we can support them when they do have those questions?
We're on the path.
We are on the path, and I'd love to go deeper in SaaS, go a little bit deeper in CPG, and like really hone in on some of those innate problem statements that exist in those industries, I think that would be a good fodder for conversation going forward.
Yeah, we could go for weeks just talking about this stuff.
Ooh, maybe a mini series. Examples.
SaaS mini series.
I like it.
In the works.
Very good. Well, we've covered a lot of ground on early stage metrics and reporting and things to be considering. Thanks for joining us today. If you want to find us, you can find us at fullsendfinance.com or on LinkedIn, Stacey Feldman, CPA, or Roman Villard, CPA. Have a good one.
Bye.
Thanks for tuning in to this week's episode of Building in the Wild. If you found value in our conversation, we'd appreciate a review on Spotify, Apple, wherever you get your podcasts. To stay up to date, make sure to hit that subscribe button. For more insights and additional information, our YouTube is at Full Send Finance, and our website is fullsendfinance.com. Remember, the business landscape may be wild, but you don't have to navigate it alone. Build together, go further. Until next time.